Hey there. So you open your investing app and boom, it's a sea of red. Red, red, minus, minus. Every time you refresh, it's worse. The news is screaming, crash, recession, trillions wiped out. Your portfolio looks like it just got hit by a truck. And your gut is telling you to do one thing: panic. Sell everything. Close the app and cry in the shower. But wait, here's something wild. Many of the richest people on earth built their fortunes during moments exactly like this. Back in April of 2025, the US stock market lost $5.4 trillion in just 2 days. 2 days, the Nasdaq crashed straight into a bear market. And then, by late June, it hit a brand new all-time high. So while the crowd was panicking and dumping their stocks at the bottom, a few calm people were quietly buying and getting rich. Sounds crazy, right? So how do they actually do it? Why do stock markets crash in the first place? Is this normal, or should you really be worried this time? What secretly goes up when everything else is falling? And most importantly, how do you turn the next crash into the biggest opportunity of your life? Stick around till the end, because I'll also show you the one man who turned the scariest crash in modern history into $10 billion in profit. In this video, we'll cover everything you need to know to profit from a stock market crash. So, let's get started. Section 1. Why do stock markets crash? Before you can profit from a crash, you need to know why they even happen. A crash is simply when the market drops fast and hard, lots of stocks falling sharply at the same time. And it usually comes down to 3 reasons: bubbles, a bad economy, and fear. Let's break them down. The first is bubbles. A bubble is when stock prices climb way higher than they should, driven by hype instead of real profits. Everyone piles in, thinking it'll go up forever. Then one day people realize the prices make no sense. They rush to sell and the bubble pops. The classic example is the dot-com bubble of 2000. Investors threw money at any company with .com in its name, even ones making zero profit. When reality hit, the Nasdaq crashed nearly 80%. And get this, it didn't return to that peak for more than 12 years. Ouch. The second reason is a bad economy or scary policies. When inflation is high, food and rent get expensive, people spend less, businesses earn less, and investors sell. On top of that, when inflation runs hot, the central bank raises interest rates to cool it down. Higher rates mean loans get more expensive, businesses slow down, and stocks usually drop. That's why every time this guy, the head of the Federal Reserve, opens his mouth about interest rates, the entire market holds its breath. The third reason is black swan events. That's just a fancy name for sudden, unexpected shocks like wars, pandemics, and financial scandals. In 2020, nobody saw COVID coming and global markets crashed over 30% in just a few weeks. Or take April of 2025 when surprise tariffs wiped out trillions almost overnight. Shocks scared people sell, and prices crash. So those are the 3 big triggers. But now the real question: is this normal, or should you panic? Let's find out in the next section. Section 2. Are a stock market crashes normal? Short answer: yes, completely normal. The market never just goes up in a straight line, it moves in cycles, up and down, up and down. And history proves it follows a repeating pattern. Pullbacks, small drops of 5 to 10%, happen almost every year. Corrections, drops of 10 to 20%, happen every year or two. Bear markets, drops of 20 to 40%, show up every 5 to 6 years. And full crashes, drops of 40% or more, happen roughly once every 10 to 20 years. Feel free to screenshot that. Now here's the part that should calm you down. Every single time the market has crashed, it has come back and gone on to hit new highs. Let me prove it. In 1987, Black Monday saw the market fall 22% in a single day, and it recovered in about 2 years. The 2008 financial crisis wiped out 57% of the S&P 500. People lost homes, retirement accounts evaporated, and yet it fully recovered in about 4 years. The 2020 COVID crash was the fastest 30% drop in history, just 33 days, but it hit a new high in only 5 months. And that April of 2025 tariff crash recovered in a matter of weeks. Here's a mind-blowing stat. Since 1871, the market has only been at a brand new high about 18% of the time. That means 82% of the time it's technically sitting below a previous peak. Being down is basically the normal state of the market. And even crazier if you had invested at the absolute worst moment, the very peak right before 1929, 2000, or 2008, and just held on for 20 years, you still would have made money. Every single 20-year period in history has been positive. But And this matters. This mainly applies to big stable economies like the US. In smaller or unstable countries, recovery can take much longer or go very differently. And you should only truly worry if the entire system breaks, like banks collapsing, people unable to access their money, the country defaulting on its debt. Those situations are extremely rare. Most crashes, they're just part of the game. Okay, so crashes are normal and they recover. But here's something almost nobody talks about. Some things actually go up during a crash. Let's find out in the next section. Section 3. What goes up when everything crashes? Here's a little secret. A crash isn't red for everyone. While most stocks bleed, money doesn't just disappear, it runs somewhere safer. Investors call these places safe havens. Let's look at 3 of them. The first is gold. When people get scared, they rush to gold because it holds its value when paper assets don't. During the 2025 crash, while stocks were collapsing, gold jumped about 25%. Gold mining companies were some of the biggest winners of the entire period. Fear is basically fuel for gold. The second is defensive sectors. Think about it. Even in a brutal recession, people still get sick, still eat, and still keep the lights on. So healthcare, utilities, and consumer staples, the boring, unsexy stuff, tend to hold up way better than flashy tech. In the 2025 crash, health insurers and discount retailers actually gained while almost everything else was falling. When times get tough, cheap and essential wins. The third is cash itself. Now this sounds boring, but cash is secretly a superpower during a crash. When everyone is panicking and forced to sell, prices get ridiculously cheap, and if you're holding cash, you can swoop in and buy amazing companies at a massive discount. Cash during a crash isn't just safety, it's ammunition. Remember that word, ammunition. We'll come back to it. So a crash quietly rewards the people who prepared. Now, this next part is the real difference between the people who lose everything and the people who quietly get rich. So pay close attention. Let's go to the next section. Section 4. How to profit from a stock market crash. All right, this is what you came for. And here's the truth. Most people lose money in a crash not because of the crash itself, but because of the mistakes they make. So let's go through the biggest mistakes and what smart investors do instead. Mistake number 1. Panic selling. When people see red, they sell to stop the bleeding. But here's the truth. You haven't actually lost any money until you sell. A stock that's down can still recover. But the second you sell at a loss, that loss becomes real and permanent. Instead of panicking, strong investors stay calm and hold their quality companies. And here's the stat that should be tattooed on every investor's brain. If you missed just the 10 best days in the market over 30 years, your total returns would be cut in half. Miss the 30 best days, and you'd lose a whopping 82% of your gains. Now here's the kicker. About 78% of the market's best days happen during bear markets, right in the middle of the panic. So the people who sell in fear almost always miss the exact days that would have made them rich. Mistake number 2. Trying to time the bottom. Everyone wants to buy at the exact lowest point, but nobody, not even the pros, can predict it perfectly. Wait too long and you miss it. Buy too early and it drops even more. So instead of guessing, smart investors use dollar cost averaging or DCA. That just means investing a fixed amount regularly, no matter the price. You automatically buy more when it's cheap and less when it's expensive. During the 2000 crash, someone using DCA lost less than 2%, while someone who dumped it all in at once lost nearly 14%. The stress of perfect timing just disappears. Mistake number 3. Buying garbage just because it's cheap. When stocks crash, literally everything looks like a bargain. But not everything recovers. Some companies just die and never come back. That's why you focus on strong companies, ones with low debt, real profits, and a history of surviving tough times. In a crash, great companies go on sale not because they're bad, but because everyone's panicking. That's your window. Mistake number 4. No diversification. If you dump everything into one stock and it tanks, you're finished. Smart investors spread their money across sectors like tech, healthcare, and utilities. So if one falls, the others cushion the blow. And if picking individual stocks feels too hard, index funds and ETFs do the spreading for you automatically. Now, those are the moves for regular investors. But there's one more strategy the pros use to profit when prices fall, called short selling. It's basically betting that a stock will drop. Imagine your friend owns a stock worth $100. You borrow it, sell it for $100, and wait. If it drops to $70, you buy it back, return it, and pocket the $30 difference. Some legendary investors made billions doing this. But if the stock rises instead, your losses can be unlimited. So I'm only explaining it for knowledge. It's extremely risky, and I don't recommend it unless you truly know what you're doing. So the formula is simple. Stay calm, keep buying quality, spread your bets, and let time do the heavy lifting. But does this actually work in real life? And who's that man who made $10 billion? Let's find out in the next section. Section 5, Real Examples and the Big 2026 Question. Let's talk about the greatest crash profiteer of all time, Warren Buffett. In 2008, while the world was falling apart and everyone was screaming sell, Buffett was buying. He put $5 billion into Goldman Sachs right in the middle of the panic, a deal that earned his company over $3 billion in profit. His crisis deals from that era eventually made around $10 billion. There's your $10 billion man. His famous rule? Be fearful when others are greedy, and greedy when others are fearful. But here's the fresh twist for 2026. Buffett retired at the end of 2025, handing the reins to a new CEO, Greg Abel. And guess what his company Berkshire Hathaway is doing right now? Sitting on a record pile of cash, around $397 billion. That's more than a third of the entire company's value, just sitting there, waiting. Why? Because prices today are extremely high and they are patiently waiting for their moment. That's the ultimate lesson. The smart money isn't always buying. Sometimes it's holding ammunition, waiting for the exact crash that everyone else is terrified of. And that brings us to the giant question hanging over the market right now. The AI bubble. Are we in another dot-com situation? Well, it depends. On one hand, it looks scary. The 10 biggest stocks now make up about 35% of the entire S&P 500, and over half of professional fund managers openly call AI a bubble. On the other hand, it's different from 2000. Back then, dot-com companies had zero profits. Today's AI leaders make real money. NVIDIA alone pulls in over $200 billion in revenue with huge profit margins. So it's genuinely not a clear yes or no. But there is one real danger. Because those few giant tech stocks now carry the whole market on their backs, if just a handful of them stumble, they could drag the entire market down with them. That's the part that keeps investors up at night. But here's the real wisdom to take away. Even if AI is real and world-changing, remember this. The internet survived the dot-com crash and changed the entire world, yet most dot-com investors still lost their money. A great technology and a great investment are not the same thing. So whether the next crash comes tomorrow or years from now, the playbook stays exactly the same. So, in conclusion, a stock market crash feels like the end of the world, but history tells a completely different story. It's just part of the cycle. Markets fall, panic spreads, and then again and again they recover and climb even higher. Remember that April of 2025 crash we opened with? $5.4 trillion gone in 2 days, and back to record highs by summer. The people who lose are the ones who panic and sell at the very bottom. The people who get rich are the ones who stay calm, keep buying quality, and treat fear itself as a discount. So the next time you open your app and see a sea of red, don't panic. Remember, this might just be the opportunity you've been waiting for, so don't fear the next crash. Be ready for it. Oh, and a quick reminder, this is not financial advice, just education. Always do your own research before investing. And if you want me to make more videos explaining these topics, please like and subscribe. Thanks for watching.